Good morning, everyone, and welcome to our weekly COVID-19 update. This is our update for April 22nd, 2020. I'm Ken Adamo, Chief of Analytics at DAT, and I'm here with Ned Damon, who is our Principal Data Scientist at DAT. Ned, what do we have going on out there in the markets this week?
Unfortunately, this week has been very similar to last week in that there's been a sustained downward slide in spot rates, which isn't great. But I think we're going to talk about that in a lot more detail in just a minute, because you're going to be talking about supply and demand metrics, our rates and the trends that are going on in our rates. And then after that, I'll be talking a little bit about our forecast models, both what we had last week and then what we're forecasting this week. And then we're going to answer a question from our inbox at askiq@dat.com. That's askiq@dat.com. Please do send us your questions. We love to hear from our customers. Or, if you just want to comment about my extremely unstylish quarantine beard and lack of haircut, you can fire those off too. Just send those burns right in. Ken?
Thanks, Ned. Yeah, I think a lot of us are shopping for hair clippers on Amazon right now. It's kind of we're into the dog days of the quarantine. All right, so diving right in, we have a lot to share this week. And right off the bat, before we talk about market dynamics, one thing I wanted to kind of give a quick summary on is the for-hire trucking market, right? So it's spot and contract. That's the largest two segments that make up the for-hire trucking market. The contract market is much larger than the spot market, but neither one is really more important than the other. Most respected industry experts would say that the spot market is the best way to tell what's going on right now. But again, they're both very predictive of each other. There's a reciprocal relationship between things that happen in one will translate into the other, and vice versa. So a lot of what we're going to talk about today and what we've talked about in the past is spot market related, because we want to capture what's happening right now in the freight markets, given a situation like the coronavirus pandemic. So jumping right in, we have dry van load to truck ratios, which this is they've sort of flattened out a little bit. This is the second week that they're below one, right? Which means there's more trucks posted than there are loads. But the fact that they're flattening out is a good sign. So kind of flipping to loads and trucks, what we see is that load posts have leveled off a bit, which is good, but they're still, severely below where they've been the prior 3 years. But also what's driving that load to truck ratio flattening a bit is that there's been fewer truck posts. We suspect that's largely due to trucks realizing that there's not as many loads out there and they're just not posting their truck. They might be sidelined for a little bit or just sort of out there searching as opposed to posting. On the reefer side, we've seen some deceleration in the downward trend, but not quite as much flattening as we've seen on the dry van side. And again, I'm going to pivot over real quick to the load and truck posts so you can see that, again, load posts continue to fall, but we've also seen some of that contraction that we saw in dry van happening in the reefer market as well. This is a quick look at what our new product, the Market Conditions Index that we released a couple of weeks ago. This is what it looked like last time we spoke. Just a level set. The red represents a very tight market. The blue represents a very soft market. And I think we're all feeling the fact that the map is a little blue this week. It's actually very blue. And it has been for a few weeks. So what we see here is there are some pockets of relative strength. We had San Francisco here last week. We had Southern Texas. And we had this kind of lower New England area that was showing some strength. I'm going to quickly pivot to what the map looks like as of yesterday. And again, not much has changed. Still a lot of blue from coast to coast, but we are seeing the pockets of strength move a tiny bit. So we're seeing Southern California, Central Texas, Florida, and again, a little bit of cooling off there in the lower New England area. So again, not a great picture. I think this encapsulates what we're all feeling out there as it relates to market activity. And we'll answer a question about market conditions here a little later in our update in a second. So talking about spot rate trends, we've talked about in the past, right? A lot of what happens here mirrors what happens in the load board from a load to truck perspective. And that is highly predictive of what's going to happen in the spot market. So again, not a great story if you're a carrier out there. Dry van rates have plummeted below where they started pre-restocking frenzy. They've dipped below 2019, you can see here, dipped below 2017, and then are rapidly approaching where spot rates were in 2016. Important to note, this excludes fuel. If we were to show fuel here, given what's happening in the oil markets, we could actually see some more deflationary pressures in rates. What we do is we break it into the long short-term view. So it's basically a 3-day versus a 7-day moving average to give you that sort of hyper recent look without confusing the models with day of week effect. So the positive kind of silver lining here is that we're seeing the 3-day rate start to find some support around $1.35 a mile. So we would suspect that the little bit of a longer term trend, the 7-day, some of that downward momentum will kind of come out, and we were hoping that that shows some support for some bottoming out. On the reefer side, again, rates kind of taking a beating. At this point, we're the lowest we've been in 6 years during this time of year. On the refrigerated side, again, a lot of this has to do with the fact that a lot of food products, a lot of grocery products go to high school cafeterias, university cafeterias, restaurants, and those things are by and large closed nationwide. Long-term, short-term, again, it's a little harder to see here, but we are seeing some of the same bottoming out pattern. We don't know how it's going to translate over the coming week or next week or two. But what we are hoping is for this seasonal upturn that we would typically see in the reefer space to take hold towards the tail end of this month and into early May. A lot of that's weather dependent. A lot of that's demand dependent. So if restaurants start to reopen for fresh produce, that will be highly dependent here. So I'm going to turn it over to Ned now to talk about some of our modeling projections and how they've been faring over the past couple of weeks. Ned?
Thanks, Ken. So to go through, this graph is the forecast that we made back on 4/14, and we can kind of track those against what's actually happened to see how well they're performing. So the blue line on this chart, so this is a chart of the spot rates without fuel. On the left, or sorry, not on the left, in the blue line, you can see our historical data going up and then come up to the peak during the height of the restocking, and then it's been plummeting down since then. And then you can see in green our ratecast model that was generated back on 4/14, and in red our pessimistic model that was generated back on 4/14, and then in the middle we've got our two blended forecasts. So those blended forecasts are designed to kind of be a mixture of the ratecast and the pessimistic model in different ways to cover the whole space of how things might possibly unfold. So you can see a little
Ned,
bit.
Why it seems like the actuals are coming in much more closely aligned with the pessimistic model over the past week or so. Do you have any color as to why that might be?
Yeah, so our pessimistic model is designed to be very, very responsive to short-term trends, whereas our ratecast model is built to have a more broad outlook and to take more sort of seasonal factors into account. And we're in something that's very heavily driven. The current circumstances are very heavily driven by short-term trends. And so the fact that the pessimistic model is tracking the data is unfortunate, because I don't love that down into the right, but it's believable and makes a lot of sense. So next I'm going to go forward to our forecast that we generated back on Tuesday, 4/21. And we're using the same suite of models. And you can see that ratecast really wants there to be a bottom or a flattening out, whereas but the pessimistic model is continuing to go down into the right. One thing that I would say is, even though the pessimistic model is down into the right, you can see the curve is bending a little bit. We're getting some deceleration in the rate of fall, or maybe a parachute. That would be nice. And then you can see that our blended forecasts are in the middle, again, trying to span that space and cover a couple of different scenarios for what we expect might happen. I would say that depending on how things shake out, we're going to see something that's probably going to trend more towards the gray line or the red line, but I would love to see that green line be more accurate of what's going on. Ken, do you have any questions?
No, I think this kind of speaks to our willingness to sort of get out there and talk about modeling. I think we're in a period where modeling becomes far more of an art than a science, and we rely on our expertise and our industry experience to help balance out what the models are showing us. So I really appreciate the update, and I think it should give folks a really good view at what the models and what we're thinking about. All right, so next I'm going to pivot. Every week we try to answer some of the most common questions from our Ask IQ inbox. And of course, these are paraphrased because we want to make sure that they're all worded a little differently. So this week it was largely about how is market conditions index calculated and what makes it different than load to truck ratio. And to answer that, I'm going to turn it over to our principal data scientist, who is instrumental in building a lot of these algorithms. Ned, can you give us a little helping hand here?
Absolutely. So I want to start off by talking about the goal of market conditions. So market conditions is built to be another measure of supply and demand, similar to load to truck. But the difference between the two is that we try to build market conditions to be our automatic transmission version of load to truck, whereas load to truck we think of now as our kind of manual transmission version of load to truck, where load to truck is really powerful if you have familiarity with it. So for instance, you understand what baseline loads and trucks in various markets look like. And market conditions is trying to be a number that you can just read and go. You just drive.
Thanks, Ned. One of the questions that we've always gotten over the years about load to truck ratio is how do you rationalize two very disparate markets such as Boise, Idaho and Chicago, Illinois?
So load to truck ratio does not do that, but market conditions does, and that's one of the goals of market conditions. An analogy that I like to use is talking about heat versus temperature. Load to truck is a pure measure of load board temperature, but it's not really a good measure of load board heat. So to give a physical analogy, a cup of tea has a very high temperature compared to a big hot bath. But the hot bath is going to have more heat in it, more ability to do work in kind of the physics context than the cup of tea. And in the same vein, that bigger market, even though the temperature of the market might be a little lower in load to truck in market conditions, that hotter market is going to show that there's more heat energy in it. And so it's going to be easier for a carrier to find a truck in a hot MCI market, if that makes sense.
No, that does make sense, Ned. Thank you. I say, we've gotten a lot of questions from those maybe a little less familiar with freight analytics or maybe a little less experienced about how market conditions might handle some of the quirks of load board behavior. I'll give a couple examples, like double posting or neighbor posting to get your load out there to more carriers. Does market conditions address that, and how does it address it, Ned?
So our goal again with market conditions is to be kind of an automatic transmission version of load to truck, and so it's trying to handle a lot of those quirks that folks have familiarity with load to truck, but sort of simplify. So one of the things that we do is we're listening to every contributor, and we're tracking the amount of behavior they're doing, their volume. So if you're very loud, if you're uncharacteristically loud, or if you're just loud in general, what we do is we kind of turn down the volume knob on you a little bit so that we can hear all the other instruments, everybody else's activity. You're just going wild on the trumpet. We want to be, that's great, and that's a signal, and we want to hear that, but we also want to make sure that we can hear everybody else, and we can hear all of what's going on so that we can get a very good overall picture of how the market is behaving. Does that answer your question, Ken?
Thanks, Ned. Yeah, it does. I think we all wish we had that volume knob, especially those of us with children working in this quarantine. So just to kind of wrap things up, we appreciate everyone tuning into these. I want to point you guys to the DAT.com/COVID-19 page. We're putting all of our updates out there. We should have an update out later today or early tomorrow. Also, a plug for our Ask IQ at DAT.com inbox. We've had many people reach out for the free 50 lane report, the DAT Daily 50, and just with general questions about the freight market. We'll be here next week at this time, updating everyone on what's going on in the markets. And again, thanks for tuning in. Be safe, be well, and take care.
Bye, everybody.